students, it is time for chapter 4, and after going through accrual entries, you'll probably feel like chapter 4 is a little bit simpler because some of the things we're going to talk about are much more conceptual in nature and kind of interesting. So this chapter is a lot about financial controls and why they exist and what we do to try to make sure the integrity of those financial statements that we give to investors actually has some meaning and some merit behind it. So we're going to start by talking about this word, internal controls. And internal controls is a fancy word for just meaning we're going to do everything we can. We're going to set up specific procedures to keep those financials safe. And by safe, I mean as accurate as possible, right? And if you think about reasons that financial statements might not be accurate, right, you can have mistakes, right? We're all human, even though we have a lot of computers involved, we can all make mistakes. We can misinterpret what the FASB, those guys in Connecticut, tell us to do with our accounting. I'm not going to spell that, interpret. Tell us how to do accounting, and we could do it wrong. And if we do it wrong, well, now our financials aren't necessarily comparable to everybody else's. And then we can have fraud. And we'll talk more about that and where the accountant's role is in actually finding fraud and determining fraud, right? Fraud can be things such as theft, right? Stealing company assets, money, things, or it can be just misrepresenting the financial statements because maybe you're the CFO and you're going to make more the better the company does. So you decide you're going to maybe cook the books a bit and make net income higher. So, as we talked about, you can have errors, right? And there's big errors and little errors. The first thing I want you to understand is it doesn't matter how good of employees you have, how good of systems you have. Every single company out there is going to have errors. What matters is how big they are, right? Because if they're so big that they would mislead an investor, that's a problem, right? If you worked at Bank of America, which I think their balance sheet is $1 trillion these days, and somebody makes a journal entry incorrectly for, let's call it even $100,000, well, that's not big enough to really change anybody's opinion on Bank of America when they read their financial statements. But if we contrast that with a smaller local company who maybe they have assets of, $100,000, well, now a $10,000 entry really is impactful, right? Because now it's enough to really mislead people on the health benefits of the health of the company. And again, we talked about fraud. Fraud can be theft, and fraud can be misstating. So companies are required to go ahead and put internal controls in place to prevent errors and fraud. So let's talk a little bit about fraud. Right? It sounds theoretical. It sounds like something people wouldn't do, or gosh, wouldn't the auditors catch it? But it's very, very real. We even have probably, I would say not even 2 or 3 weeks goes by where I don't read something in the Wall Street Journal about another large multi-million-dollar corporation where somebody has committed fraud. Back in the 90s, fraud was, or maybe it was even early 2000s, fraud was very real. We had these companies, Enron and WorldCom, that their highest level employees, their CEOs, their CFOs, they cooked the books, right? They altered their income statements so that their companies looked more profitable, so that they would make more money and keep their jobs. So we can talk more in class about exactly what they did, but it's kind of interesting. And then, I celebrate everybody, but yay, girl power. These 3 ladies actually were the women who found these various issues. They were primarily internal auditors that found them just by asking a lot of questions. So as we've gone over time and these major scandals took place, Congress got involved again. And Congress said, gosh, if in here the year 2000s, companies can still get their financials wrong and force their accountants to make these bad entries, we need to do something about it. And so they passed legislation, and this legislation did a lot of different things, but it established a lot of guidelines for those internal controls. it told companies how they could interact with their auditors, right? They wanted to make sure those auditors are more independent, meaning they're not tied to the company or beholden to the company, right? And so, you know how it is when sometimes, you know, you're not independent, you're not as, what's the right word I'm looking for? Skeptical, right? I'm necessarily looking for fraud. And they also created something called the PCAOB, Public Accounting. Oh, the PCAOB actually is the group that they created, right? Public Company Accounting Oversight Board. And that's the auditors of the auditors, right? Isn't that funny? That's why I always encourage students, if they enjoy this class, to pursue an accounting degree, because there's so many different jobs, right? So our auditors of the auditors are the PCAOB. That and these additional internal control procedures and the rules about the clients all came through this Public Company Accounting Reform and Investor Act. People in the U.S. call it SOX. You're going to hear that throughout your career because SOX permeates every large company. The other interesting thing they did in this act is that they forced the CEO and the CFO to now sign a statement once a year saying, yes, these financials are right, and I'm willing to go, I'm drawing little prison bars here, I'm willing to go to prison if they aren't. That was, I will tell you as an accountant, a huge game changer. It's a very different conversation when you go to your CEO and CFO and ask them to sign this piece of paper, which was my job for a long time. And I'll talk about this in class a bit, but it makes them look harder. They want more proof. They want to know these are good. And then they feel that sense, obviously, of personal accountability. So let's talk more about internal controls, right? So remember, internal controls are trying to eliminate the opportunity, right, of fraud and accidental errors. Nothing's going to get 100%. It's just not feasible, right? Especially if there's collusion, meaning that two people work together to try to defraud the company. But internal controls can do a good job of making sure some of these things don't happen. And we put controls into two buckets: preventative and detective. Preventative means I'm going to try to catch that error before it ever happens. In other words, I'm going to try to make sure it never happens. Detective means that the error has already happened and I've caught it on the back end before we do the reporting, right? So we'll talk more in class about this, but like, which would you prefer? Probably preventative, because you want to stop issues before they can ever begin, right? And let me give you just an example of that, and we'll go through more in class. But the key cards that are used to get into the dorms, right? Those key cards are a way that they are trying to prevent unauthorized people from getting into the dorm. Whereas detective controls, right? Let's just say maybe then they have, I'm making this up, a hall monitor to try to catch anybody that came into the dorm that shouldn't be there. So swiping your card to get in is preventative. Having people that are looking out for anybody that got past that one is detective. All right, so that's everything I want to cover on internal controls. There's going to be one more video talking about cash and how we protect our cash, because that's one of our most valuable resources.